European financial markets opened Tuesday under a cloud of caution, marking the end of September 2025 with a sense of unease. The atmosphere was thick with apprehension as investors braced for potential market shifts. The usual morning buzz was replaced by anxious restraint, a stark contrast to the typical hustle and bustle. Traders from Frankfurt to London hesitated, wary of looming risks. Conversations were hushed, and every decision was made with extra caution. Major indices wavered, reflecting uncertainty rather than panic. The markets were in a delicate balance, teetering between stability and volatility. The main source of this tension, troubling signals from the United States. News from across the Atlantic had a profound impact on European sentiment. Developments in U.S. trade policy and the threat of a political stalemate in Washington cast long shadows over Europe. The interconnectedness of global markets meant that no region was isolated from the ripple effects. In today's interconnected world, American turmoil quickly ripples across the Atlantic. European investors were acutely aware of this, monitoring U.S. developments closely. Investors shifted from chasing gains to protecting capital, focusing on risk management. Strategies were adjusted to mitigate potential losses. What if U.S. tariffs escalate? What if the government shuts down? These questions dominated trading desks. The uncertainty was palpable, and every scenario was considered. The day's early dip, though modest, signaled a broader shift in sentiment. It was a clear indication that the market was on edge. Investors recalibrated expectations for the final quarter, bracing for new layers of risk. Projections were adjusted, and strategies were re-evaluated. Every headline from Washington would be scrutinized, as Europe waited for the next move. The financial world held its breath, anticipating the impact of each new development. The biggest jolt to European markets this week came from President Trump's surprise Monday announcement of sweeping new U.S. tariffs. The move, which caught many investors and analysts off guard, sent immediate shockwaves through financial centers across Europe, as traders scrambled to assess the potential fallout. A 10% tariff on timber and a steep 25% on items like kitchen cabinets and furniture sent shockwaves through global supply chains. These new levies target some of Europe's most important export sectors, threatening to disrupt established trade routes and upend the business models of companies that rely on access to the vast American market. The official rationale from the White House was clear: protecting the U.S. economy and national security. Administration officials argued that these tariffs are necessary to shield American industries from what they describe as unfair foreign competition, and to ensure the country's long-term economic independence. For European exporters, especially those in construction materials and home goods, the new tariffs meant higher prices for their products in the U.S. market and shrinking demand from American buyers. Many companies now face difficult choices: either absorb the extra costs, pass them on to consumers, or risk losing market share altogether. Investors quickly reassessed the earnings outlook for any firm with significant American exposure. Financial analysts rushed to update forecasts, and multinational corporations began reviewing their supply chains for vulnerabilities. The uncertainty rippled through boardrooms and trading floors alike. The fear was palpable. This could be just another round in an unpredictable and escalating trade war. With each new tariff, the risk of retaliation grows, and the possibility of a broader economic slowdown looms larger. Trump's aggressive approach injects volatility into the global economy, forcing businesses to delay investments, reconsider hiring plans, and hedge against future barriers. Many executives are now bracing for further disruptions, unsure of what policy changes might come next. Uncertainty drives up risk, prompting investors to sell off stocks in exposed sectors. The result: sharp declines in share prices for companies tied to international trade, and a general sense of unease in the markets. The message was clear: so long as trade policy is wielded as a political tool, markets will remain vulnerable to sudden shocks. Policymakers in Europe and beyond are now under pressure to respond, but options are limited. Stocks in industrials and materials dropped sharply, reflecting the defensive mood among investors. Many are shifting their portfolios towards safer assets, waiting to see how the situation develops. The calm of recent months was shattered, and old trade war playbooks were back in use. Memories of past disputes resurfaced, as companies and governments dusted off contingency plans. Europe braced for more turbulence as global trade tensions reignited, with many wondering just how far the current standoff might go, and what it could mean for the future of international commerce. Adding to the anxiety was the looming threat of a U.S. government shutdown, a scenario that has become all too familiar in recent years. The mere possibility of federal agencies grinding to a halt sent a chill through financial markets, as investors braced for the potential fallout. With a funding deadline fast approaching and political deadlock deepening, Vice President J.D. Vance's blunt warning, "We're headed to a shutdown," spooked global investors. The standoff in Congress, marked by heated debates and little compromise, only heightened the sense of uncertainty. A shutdown means hundreds of thousands of federal workers could be furloughed, essential services suspended, and critical economic data releases delayed or canceled. This disruption would not only drag on U.S. growth, but also undermine confidence in the world's largest economy. For Europe, the consequences are immediate and tangible. Weaker demand for exports, coupled with more global uncertainty, threatens to slow the continent's already fragile recovery. European businesses and policymakers are left anxiously watching Washington, knowing their fortunes are closely tied to U.S. stability. The risk extends to U.S. financial assets, the backbone of global markets. Treasuries, stocks, and the dollar all came under pressure as investors weighed the possibility of prolonged dysfunction in Washington. Memories of last year's Moody's downgrade linger, casting a long shadow over current events. Another prolonged standoff could trigger further credit concerns, potentially raising borrowing costs for the U.S. government and businesses alike. Higher U.S. borrowing costs and instability in treasury markets would ripple worldwide, affecting everything from mortgage rates to corporate financing. The uncertainty makes it harder for businesses and households to plan for the future. Investors responded by reducing exposure to riskier assets, especially stocks. Many sought safety in cash or gold, while others simply waited on the sidelines, hoping for clarity from Washington. The threat of stagflation, stagnant growth, and high inflation added to the gloom. Rising prices and slowing economies are a toxic mix for markets, and the specter of both loomed large. With valuations already stretched, markets were primed for a negative shock. The sense that stocks were priced for perfection made the risk of a sudden correction even greater. The political dysfunction in Washington was just that shock, prompting a defensive retreat. Investors, traders, and ordinary citizens alike watched with frustration as gridlock threatened to derail economic progress. European indices dipped, mirroring the heightened anxiety. From Frankfurt to London and Paris, the ripple effects of Washington's troubles were felt across the continent. The day's trading reflected a market bracing for economic fallout from U.S. gridlock. Volatility surged as investors tried to gauge just how far the damage might spread. The world watched Washington, knowing its decisions would shape global fortunes. As the drama unfolded, one thing was clear: the stakes had never been higher for markets everywhere. Amid the macro gloom, company news also moved markets. Lufthansa shares plunged 4.3% after announcing a restructuring plan with 4,000 job cuts by 2030. While aimed at long-term efficiency, the immediate focus was on the negative outlook and human cost. UBS analysts noted potential upside if targets are met, but the market wasn't convinced. Meanwhile, Pandora dropped 2% after CEO Alexander Lacik announced his retirement. Leadership changes, especially after a successful turnaround, create uncertainty. The new CEO, Berta de Pablos Barbier, brings experience, but investors remain cautious. Both stories showed how sensitive markets are to corporate strategy and leadership shifts. Europe's major stock indices showed modest declines as the day unfolded. The Stoxx 600 dipped 0.1%, reflecting a continent-wide pause amid U.S. headwinds. France's CAC 40 fell 0.31%, hit by trade worries, while Germany's DAX eked out a slight gain. London's FTSE 100 rose 0.16%, buoyed by its commodity-heavy makeup, but anxiety lingered. Italy's FTSE MIB was flat, and Spain's IBEX 35 gained 0.33% on banking optimism. The numbers told a story of hesitation, not panic, a cautious retreat rather than a sell-off. Small gains in some indices couldn't offset the overall negative tone. U.S. trade and political worries kept upward momentum in check. While U.S. news dominated, the UK's domestic politics added another layer of uncertainty. The Labour Party's annual conference drew investor attention, with PM Keir Starmer's speech under scrutiny for economic policy hints. Finance Minister Rachel Reeves offered few details on the autumn budget, fueling speculation about looming tax hikes. Higher taxes could dampen corporate profits and consumer spending, threatening the fragile recovery. Investors weighed U.S. risks against the UK's fiscal outlook, with the FTSE's small gain masking deeper concerns. The Labour conference underscored how local politics can amplify market anxiety. To grasp Europe's mood, you have to see the global picture. In Asia, China's manufacturing contracted for a sixth month, signaling weaker global demand. This hit European exporters, especially in Germany and France. Meanwhile, U.S. stock futures were flat, hinting at stability, but not enough to calm Europe's nerves. The combination of China's slowdown and U.S. uncertainty created a complex backdrop. European markets reacted more to U.S. threats than to Asian steadiness. Regional risk assessments diverged, making for a challenging global puzzle. Investors had to piece together signals from every corner of the world. Market moves may seem distant, but they hit home for everyone with savings or investments. A market dip erodes pension and retirement values, affecting long-term plans. U.S. tariffs mean higher prices for American consumers and lower sales for European exporters, leading to job cuts like Lufthansa's. Economic uncertainty makes businesses cautious, delaying hiring, investment, and growth. Consumers, too, hold back on big purchases, slowing the economy further. The stock market is a barometer of confidence. Falling markets can reinforce economic pessimism. Policymakers and business leaders watch these signals closely. Understanding these links helps explain why global headlines matter to your wallet. As uncertainty lingers, investors are watching a few key signposts. U.S. government funding talks remain front and center. Progress could spark a rally, while failure risks a deeper sell-off. Trade policy statements from Washington and responses from abroad will be scrutinized for signs of escalation or relief. In the UK, the Labour conference and upcoming autumn budget will shape domestic sentiment. Details on tax and spending will determine market reactions. Global economic data, especially on inflation and manufacturing, will provide real-time health checks. In this nervous environment, every headline and data point could tip the balance.